I'd like to go ahead and bring in Marci Rossell. Marci joins us quarterly for an economic outlook. She's the former chief economist for CNBC, very highly regarded in this area. So Marci, welcome. It's great to have you back with us today.
It's great to be back, Michael. Thank you so much for having me. It is certainly very interesting times for the economy.
I bet. I mean, that's, I think, probably an understatement. Marci, we have about 20 minutes or so. So I was thinking maybe we can kind of break the discussion up into four equal parts, or 4 parts that don't need to be entirely equal. Maybe start off talking a little bit about inflation, kind of get your thinking on employment and employment numbers. Maybe pivot a little bit to the general economic outlook, and then kind of close with some insights on supply chain, if that all makes sense. And I guess I'll kind of get us going with, as a conversation starter, and maybe we begin with inflation. Do we think it's coming under control? What are your general kind of thoughts on status?
Well, it looked as if prior to the invasion of Ukraine back in January, February, that inflation should have peaked really about 9 months ago. And simply all of the pandemic related issues were sort of beginning to work themselves out. But then we had this massive supply side shock to the global economy that came in the early part of this year when Russia invaded Ukraine, and we saw energy prices spike and we saw food prices spike as well. Now, one of the things that appears to have happened is that energy prices, particularly oil prices in the US, have come down. And we've seen that sort of flow over into the price of gasoline, which peaked in June and has done something very unusual over the course of the summer, which is go down instead of up. So normally during the summer season, the driving season in particular, when people hit the road, oil, energy prices, particularly gasoline prices, they tend to go up, but they came down over the course of this summer. So it appears as if the headline inflation numbers peaked in June of this year, and we've seen one consecutive month of lower numbers, and we'll get another piece of data next week on the inflation numbers for August. And economists, including myself, expect those numbers to be low in the sense of 8% instead of 9%, right? So not a great inflation headline number, but I need people to remember a couple of things. It takes time for 2 things to happen. It takes time for inflation numbers, the headline number, the year over year number, to come down. So even though month over month, the inflation numbers are getting better and better, it's a real lag from year over year before we get back to normal. So I expect this time next year, you should have an inflation number year over year that's probably running 4% or less. And it'll take another year to get us down to the Federal Reserve's target, which is a 2% inflation rate. But Michael, I want to remind everyone of this. The Federal Reserve has been raising rates aggressively. They made it very clear at their meeting in Jackson Hole earlier this month that they were committed to getting inflation completely under control. And I believe that all of that talk and action from the Federal Reserve is an effort to basically get them in front of inflation, because people had perceived them to be, the cliche, is behind the curve, right? Everybody says the Fed was behind the curve a year ago. They now find themselves in a position where they have taken strong enough action and they're talking about it in the right way, finally, that people believe that they're going to get inflation under control. And if you are of the opinion, like I think many of you were, that loose monetary policy causes inflation, and we know that loose monetary policy coupled with really aggressive fiscal policy delivered inflation to the U.S. economy for the first time since really the 1980s, then you also have to believe that tight monetary policy will get inflation under control. You can't believe one without the other. So if you think that loose monetary policy was responsible for the inflation, then you must also believe that tighter monetary policy will get it under control. And we have tighter monetary policy coming through higher interest rates from the Federal Reserve. So they're making what have come to be known as jumbo increases, where a normal Federal Reserve increase is 25 basis points. They're doing 50 basis points and might even do 75 basis points at their last meeting. We also saw the European Central Bank raise rates this week, and they took the unprecedented step of also raising rates 75 basis points. So you have central banks around the world who are taking steps to tighten monetary policy. And it appears from the behavior of currency markets, where you've got this really strong dollar. If you look at the value of the dollar relative to every other currency on the planet, with the exception of one, and that's the Russian ruble, which is being artificially inflated with capital controls. If you look at all the free floating currencies on the planet, the US dollar has appreciated relative to all of them, which is a strong signal that the Federal Reserve is committed to supporting and protecting the value of the dollar by keeping inflation under control, doing whatever it will take. And currency markets are our strongest signal that it is finally happening.
Marci, if I could interrupt you there real quick. So I think Powell came out again today and kind of once again emphasize that commitment that you're talking about. Do you think this 2% is a real 2%? You think it's a range? Is it they just want to see? I don't know that the Fed would ever come out and move off of that because just of what it how it might be interpreted. But what's your general thoughts on it? Is that a true target, or it's as long as it's moving in that direction?
Well, I think as long as it's moving in that direction in a sustained way, I think they're going to be satisfied. But that, again, will take some time. And so don't expect this to be the last rate increase. I do think you're going to see them probably get it to a level, say, closer to 3%, because that's probably the proper Fed funds target rate for an economy that's going to be growing at about 2%. So I think that they're going to have to take it to 3%. But it wouldn't surprise me if the last couple of increases were back to those normal 25 basis point increases. I expect they'll probably do one more jumbo increase. And once they do that one more jumbo increase, they'll have 2 months of data. And if those 2 months of data go their way, then it's possible that they could shift back to 50 basis point increases and then shift down to the 25 basis point increase, which is much more normal and will be their signal to all of us that they're getting comfortable with where things are.
Great, thanks, Marci. Let's kind of pivot to employment numbers. I think growth seems to be tempering or slowing. I think when we've talked in the past, one of the things I've appreciated you saying is really the pandemic was an acceleration of what was already in motion, and we definitely have the demographics of not only the U.S. but even globally of more people, it seems like, exiting work than coming into work. And so it would appear to be that this is not something that's going to turn around or correct. It's going to be something we're going to need to live with and manage through. But curious to get your latest update on just general employment and those trends.
Sure. Well, I think the sort of headline might be, we're all Japan now, right? We are all entering that phase where people are exiting the labor force very, very quickly. And we could all see that coming. We knew the baby boomers were eventually going to retire. It's just that COVID escalated their retirement from the labor force. So the Federal Reserve Bank of St. Louis has done some work that suggests that about 2.5 million additional people above and beyond what you would expect retired during the pandemic. And we've talked about this before. So you've got those 2.5 million people that they've moved to Florida, and they're probably not going to re-enter the labor force. But because of demographic reasons, we also find ourselves in a situation where that big bubble of millennials is all moving into their 30s, and the Gen Z and whatever next generation comes behind them is actually going to be much, much smaller. So you've got fewer young people entering naturally because they simply weren't born. They just don't exist, right? But all of that being said, in the latest unemployment report from the Bureau of Labor Statistics that came out that sort of documented what happened in August, The economy crossed a major milestone in my mind, in that there are currently now as many people back employed today as there were prior to the pandemic. That's a real milestone in suggesting that labor markets, just like so many other aspects of our lives, are finally going back to sort of normal pre-pandemic conditions. Now, the unemployment rate, though, is still remarkably low. It ticked up a little bit to 3.7% last month. But part of the reason it ticked up is a lot of folks are now finally re-entering the labor force. You have kids going back to school, and it looks as if their schooling this time around isn't going to be disrupted by the pandemic. So that was a major factor keeping moms out of the workforce. So now that you have that consistent childcare that's going to come from the school year, you can have that generation of moms entering the labor force more confidently, perhaps, than they did last year. So we have labor markets going back to their normal economic conditions, the pre-pandemic conditions. We passed that milestone, like I said, in August. However, you have these long-term trends that were going to happen no matter what. Even without the pandemic, the baby boomers would eventually retire. It just would have been a little more gradual. And we would have been sort of suffering from the fact that you just don't have as many young people. It's not that they're not working. It's just that they aren't there. They don't exist. And so we find ourselves sort of having to face these long-term challenges that each and every business person out there that you deal with is going to be complaining about, not just this year, not just next year, but indefinitely. This is the world we live in now. It's the biggest long-term challenge that the U.S. economy faces and in any other industrialized country in the world.
And Marci, you've covered inflation. We talked now about employment. Maybe combine the two. Wage inflation seems to be very real and not something that's going to go away anytime soon. I mean, talk about that, because again, it seems like salaries are very high, and it's going to, or at least increasing, and that looks like for the foreseeable future to want to stick.
Yes, I do believe that those salary increases will stick, and part of it is a shifting in the balance of power between workers and employers. You see, in the wake of the financial crisis of 2008 and 2009, the recovery from the financial crisis was delayed. It was like molasses, if you remember it. It took a long time to recover because of the nature of the debt hangover that Americans were all facing. So anytime you have a lot of leverage going into a downturn, one of the recovery tends to be very slow and very difficult because it takes people a long time to repair their balance sheets and get back to spending money the way they did prior to the recession. So that recession of 2008, 2009 was sort of was followed by a really weak and difficult recovery where it was really easy to find workers. Unemployment remained elevated for a really long time. So you could put out a job posting and you'd get decent candidates and a lot of them. But that was a temporary cyclical event. And I think we began to think, hey, this is normally how labor markets are going to be. But as we were going into the pandemic, I suspect that if each and every one of you sort of think back to prior to the pandemic, if you can imagine life before, you were struggling to find workers even then. So it was already getting difficult. The balance of power was already shifting. The pandemic came along and just made a couple of things like remote work the new norm, right? So again, shifting the balance in favor of workers as opposed to employers. And rising wages sort of taking a bigger bite out of profits. I think that that's part of, number one, what the stock market is struggling with right now. Sort of what does the future look like when workers in general are going to capture a larger share of the profit pie than they have over the last about 20 years. And when you couple that, with all those demographic factors I was talking about, it's a recipe for a much tougher environment for employers. And so as a business person, what do you need to do? What are the solutions? Well, I think there are two solutions. Number one, you got to keep the people happy that you have. And I read a wonderful story recently where they were talking about the importance of the exit interview, right? And you guys have all done exit interviews. It's become part of sort of our sort of corporate culture in the United States. And this writer said, don't ever let it get to that point. Don't let it get to the point of an exit interview. You need to be doing retention interviews. You need to be talking about to your employees to figure out what is it going to take for me to keep the ones that I want to keep. So those retention interviews, I think, are part of the change in the corporate culture. They're going to keep your people happy because people get big wage gains when they switch jobs. That's when it happens. So you want to keep people from switching jobs. That's the first thing. And the second thing is we have to do whatever it takes to embrace labor saving and labor augmenting technologies. And nobody likes to adopt new technologies. Michael, I don't like to get a new iPhone, and I'm pretty good age adjusted with technology. Even though, I wear pink dresses, I can still manage a computer pretty decently. But even I don't like to switch phones. I don't like to deal with new technology because I'm going to spend some time having to learn it. Right? So people resist. They don't want to do the new stuff. And you have to make it as easy as possible and convince them that this is going to make your life better in the long run. And I believe those two things are the best suggestions I can possibly give on how do we run our businesses in this new environment that's not going to change.
It's great advice, Marci. Let's pivot now just to looking ahead, 3, 6, 9 months out. I mean, where do you see the economy headed? Maybe even touch more specifically on Q3, but then talk a little bit about the balance of year into next year outlook.
Sure. Well, I would say 3 months ago, the recession talk kind of peaked, right, in June. And I think one of the reasons recession talk peaked in June is that consumer sentiment and people's satisfaction or dissatisfaction with the economy is highly tied to gasoline prices. So the price of the pump has a real emotional effect on people. So I've been calling it the emotional recession. It's not a real recession because for a real recession to happen, you need consumer spending to decline. You need business investment to decline. For a real recession to happen, you have to have unemployment rates go up dramatically and people start losing their jobs. So you'd see an uptick in initial claims for unemployment benefits. We haven't seen any of those things. And so back in June, July of this year, it was amazing. I would talk to people, business people all the time. They'd say, oh yeah, the economy's definitely in recession. Absolutely. And then I would say, well, how's your business? And they'd say, oh, it's gangbusters. Well, those two things can't be true. Everybody says their business is gangbusters, yet emotionally they look around and go, high gas prices, the economy must be terrible. Well, I think that talk probably peaked, like I said, in June, July. And we're now looking forward and realizing that we're going back to normal, that the disruptions from the pandemic, by and large, have faded into the background. All the stimulus faded into the background. People are going back to work. They're re-entering the labor force. And the trend rate of growth in the U.S. is 2%. That's what it is. So it's been a little below that, right? So in the last quarter, the Bureau of Labor Statistics reported that GDP declined by 0.6%. And everybody said, oh, well, see, there's a recession. And my response is, it was inventories. So whenever you draw down inventories, that can deliver you a negative GDP number. But if you look at consumer spending and you look at business investment, those two things had risen. The only component that has been hit pretty hard is the most interest rate sensitive component, and that is residential fixtures, building. So we are seeing the building sector take a real breather because the cost of money has gone up and they are still suffering from supply chain disruptions. So I expect the economy headed back to normal. Probably you'll get sort of a 1% GDP number in the third quarter. And then by the fourth quarter, expect it to go back to trend. And the stock market, even though it's been sort of a rough ride, up and down and up and down and up and down, it looks as if it bottomed out in June. And the last couple of months, it's been like up and down, up and down, up and down, but it is up from its lows, which tells me, if you believe that's a forward-looking indicator, that the U.S. economy is probably sort of looking forward in better position, certainly than many of our international neighbors, where I'm expecting a pretty rough winter for Europe and Great Britain in particular, particularly after the terrible loss of their beloved queen.
Yes.
Yeah.
Yes. And Marci, maybe ending on that note or closing on that note, you mentioned supply chain. I think we have a slide here
Yeah.
that maybe kind of supports what you were just talking about. You can kind of take us through.
Sure, exactly. Well, one of the things that I wanted to show everybody with this supply chain chart, and this is a relatively new index from the Federal Reserve Bank of New York, and it measures supply chain pressure. And this chart, they sort of calculated all the way back for 20 years, and you can see that it sort of bounces up and down, up and down, and up and down, but you get to 2020, and of course, supply chain disruptions go off the charts. But they peaked in December of last year. And since that time, we are trending downwards, right? So those numbers are getting better. But the other reason I wanted to show everybody this chart is that when it comes to inflation, we now are in a position where we can see that about 40% of the surge in inflation over the last 2 years was accounted for by supply chain disruptions. Without those disruptions, inflation wouldn't have hit 9%. It would have only hit 6%. And you can say, well, why even 6%? And the 6%, sort of the bulk of the inflation, has come from the surge in demand during the pandemic era recovery that no one was anticipating, myself included. I wish I would have known that consumers were going to basically keep their jobs because of remote work, receive stimulus checks that were going to support their incomes. And because they weren't traveling and they were saving so much money and they weren't going out to eat, they went on a spending spree when it came to refrigerators, pools, jet skis, so many things that they bought. And so those two things together accounted for the surge in inflation. But we also know that going into next year, much of the fiscal stimulus that sort of hit people's bank accounts in 2020 and 2021, most of it has been spent. So the effect on consumers is certainly in the rearview mirror. And we can see that supply chains are slowly, but thankfully, returning to normal, which gets us back, quite frankly, to where we started, which is, where does inflation go from here? And this is one of the main reasons why I believe that looking over into next year, inflation slowly returns to normal over the next 2 years, and we get back to where the economy was in 2019, which, quite frankly, was fairly boring, and I will take that.
Hey, Marci, we're going to end on that note. I can't tell you how much we appreciate having you here with us for these quarterly economic updates. I guess and it's wonderful that we're seeing a little sun come through the clouds, maybe with this latest update. And we're looking forward to having you back here in, I guess, 90 days or so in the town hall. So thank you again. Really appreciate it.